Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. After all the volatility in global share markets and cryptocurrencies, today I wanted to head in the other direction and take a look at fixed income investments. Blossom is an Australian fintech startup giving risk-averse micro-investors a way to invest in bonds. But while Blossom provides the app and the investment platform, the money will actually be managed by Fortlake Asset Management in a fund made of corporate and government bonds and mortgage-backed securities. Dr Christian Baylis is the founder and chief investment officer of Fortlake Asset Management. Christian, welcome to Fear and Greed.
Thanks, Sean. Nice to be here with you.
So much to unpack in this. So I want to talk to you broadly about fixed income investments, but first a bit on Blossom and the app and how that works.
Yeah, so Blossom is effectively a technology solution which allows us to do things like anti-money laundering, know your client, all of these things which take quite a lot of time and tend to be quite expensive from the asset manager's standpoint. So what we've done is we've developed a technology solution which fast tracks that and speeds that process up. And that's effectively what Blossom is. And it goes out to effectively what we call the unaddressed part of the market, which tends to be, millennial savers or low balance savers who typically wouldn't get access to fixed income investments. And the reason they wouldn't get access to those investments is because their balances are too small and customer acquisition is too high for the asset managers. So they tend to not focus on that. They tend to focus on the larger scalable parts of the market, like the financial planners and the industry funds and where there's bigger pools of capital.
Okay.
So really what Blossom is seeking to do is aggregate all of these small savers in an efficient way and provide one client interface to Fortlake Asset Management, who then effectively manages on behalf of this aggregated pool of people.
Okay, so in a crude analogy, I mean very crude, equities has low-cost providers, let's say CommSec as an example, which allows people to log on, put their information in, does a lot of the paperwork and the governance and allows people to buy and sell equities. Blossom is a little bit the same for the fixed income market.
A little bit the same, yeah, except you can run off your existing bank accounts and things like that. So the actual speed to the investment is quite quick.
Okay, so let's talk about fixed income investing. And for many people who aren't in the market, they think about investing in equities, but fixed income is a really big part of the market. Now, you invest in governments and corporate and mortgage-backed securities, and just run through those three and then the big advantages of fixed income over other asset classes.
Yeah, so obviously fixed income, as per the name, provides you with a fixed level of income ultimately. Now, there is also capital fluctuations very similar to equities where you've got your dividend yield, which tends to be reasonably stable over the long run, and then you get your capital volatility. So fixed income is much of the same thing. So when we look at the three assets that you've pointed out, what you do is you go out and you buy a bond, and that's obviously provided by the issuer. So a mortgage-backed security will be issued by Commonwealth Bank as an example, and that's effectively backed by all of these housing-related loans, and we get a fixed coupon off that, or we can get a fixed coupon off that. Government bonds, the same type of thing. We can go and effectively ask the government to issue bonds to us. We buy them, we get a fixed amount of income for providing those funds to them, and the same applies with the corporate bond. And typically the main corporate issuers in Australia tend to be, 40% of the market is Australian deposit-taking institutions, so mainly banks and financials. Mm-hmm. And then you've got your staple names like Woolworths and Coles and Wesfarmers and these types of names as well, who tend to be issuers in the local market as well.
And so the big advantage then of fixed income is the fact that you are getting a fixed income back every period, be it half year, and the investing is basically safer, particularly when it's the government repaying the bond, safer than other asset classes.
That's right. You higher up the capital structure. So equity is the lowest part of the capital structure. And then as you move up the capital structure, you become more and more secure. So that's exactly what we seek to do, is do everything except equity and provide people with a more secure form of income.
Now, most of us would, if you're in a balanced fund in your super fund, you would certainly hold fixed income investments. And that's the only way most of us really access bonds. But what you're talking about doing with Blossom, it sort of democratizes or actually opens up the market to people, as you say, with smaller investments, and people just want something a little bit different and less volatile, particularly than crypto and equities. Do you think there's a big market for that?
Look, I think it's a bit like an iceberg. You look at it and you don't know what's actually below the surface. And I guess that's the point of Blossom, is we're basically saying, look, we know there's a whole bunch of people out there who have never had the opportunity to effectively have a go in this asset class. Let's see if we can open up the pipes and unclog the system so people can actually get access. And let's just see what comes of it ultimately. That's the proposition that we're putting out there. And as long as we can deliver that in an efficient way, it'll be a really interesting trial run to see what is actually below the surface there.
Okay, and what sort of returns can people expect?
Yeah, so we've structured it in a way where we've stripped out any fees and we've just gone for a 3% return to the end investor. And what that basically means is we've worked with a type of insurance arrangement where the insurer effectively, says, okay, Fortlake, you manage the assets in this particular way and you try to give us a return that then we can effectively back out and give to the investor, which is 3%. And then we just manage all of the fees and everything in the background and try to deliver it. But we ultimately don't get a fee unless we deliver on that income target for the insurer.
Okay, now I just add to listeners here, we're not a financial advice show, and I'm a big fan of people going and seeing financial advisors, so we're not here giving you financial advice. But that 3% versus a term deposit, for example, which is probably paying less than 1%?
Yeah, on a good day. Yeah, definitely.
Yeah, okay. Now, you're trying to raise $50 million. Once you hit that mark, and hopefully you will hit that mark, is that when you start investing the money? How does all that work? And then what happens if there are a high demand for than $50 million?
Yeah, so at the moment what we've done is to keep costs low is we've effectively used the existing Fortlake infrastructure where the funds that come through Blossom go into one of the funds that Fortlake manages. And then once that gets up to about 50 million, what we do is we effectively do an in-specie transfer where we transfer all of those units across into a separate Blossom vehicle. And the reason we're doing that is because we're trying to keep costs low for the end user and make sure that we don't have to effectively pass on any cost at a future point in time. So it's really about trying to operate in the most efficient way, and that's effectively the way we've decided to do it.
Stay with me, Christian. We'll be back in a minute. My guest this morning is Dr Christian Baylis, founder and chief investment officer of Fortlake Asset Management. Okay, so investing in bonds, it's a tough time to do that now, though, because interest rates are so low, so your returns are going to be lower.
That's right. Yeah. So the thing I often point out is that interest rates are very low, and that is because inflation is ultimately very low. So people haven't needed much compensation for inflation. So therefore, those fixed income style returns can be very low, and because you effectively don't need to make much of an allowance for inflation. But the thing I often point out is that whilst interest rates typically can go to zero, and in some countries they've gone below zero, the thing that most don't realise is that when we look at interest rates in real terms, i.e. adjusting for inflation, interest rates can go very low. And that's what we call real rates or inflation-linked rates. And those inflation-linked rates can go down to negative 10%, negative 7% during the 1970s, negative 10% during the 1940s. And then since the early 1300s, which is when we started effectively looking at interest rates and making adjustments for inflation, there's been huge fluctuations and deeply negative fluctuations in real rates. So there's a lot of upside that you can get from investing in inflation-linked type securities. And that's what a lot of people probably don't realise. They just go, oh, well, interest rates are low, I'm not going to get much return. But you can get a lot of capital upside by effectively investing on the basis that inflation is going to pick up and therefore real rates are going to go deeply negative, and you will make quite substantial returns from that type of profile.
Okay, so if I'm investing in your fund, you've got 4 main short-term fixed income funds, is that right?
That's right, yeah.
So what are the differences? How do I choose which one to go for?
Yeah, so what we say, it's the risk, we call it the risk continuum. And what we've said sometimes in our little microcosm of the fixed income world is people can get quite technical.
Yep.
And we thought, look, let's simplify.
In bond markets, people can get technical.
That's right, like most asset classes, but I think ours is another level.
I think so.
So what we've said is, look, let's have some set return targets, and obviously those return targets have to be commensurate with a level of risk. So we've basically said, okay, we've got a plus 250 basis points over the cash rate product, and that's got a set or a targeted level of risk, which is around about 100 basis points of volatility per annum. Then we step up into a higher risk category, which is plus 400 basis points. And again, that has a higher level of risk. And that would typically be about 150 basis points of volatility. And just to put that in context, is these basis points amounts of volatility are probably comparable with the equity market, which has 15%.
Right.
So when I'm saying 150 basis points,
that's about 1/10
versus 15%.
Yep.
Yeah, exactly, of the equity market. And then we step up into what we call a higher risk category, which is 7% to 10%. And that's targeting about 400 basis points again versus the equity market, which is 15%. So that's the risk continuum that we call. And we basically have these set targets with set levels of volatility that we try to target in order to make sure that investors aren't getting return with an inconsistent amount of risk. And then we've got a government bond fund at the other end of the spectrum, which is extremely low risk, highly rated, and basically just seeks to outperform inflation.
Okay, and the way you actually get that performance, though, is by investing the money in riskier bonds. And if we think of that risk spectrum, that means that the least risky is the government bonds, as you just mentioned, and the most risky might be a corporate with a lower rating.
That's correct. And lower parts of the capital structure in the higher risk category as well. That's right. Exactly.
Okay. You talked about millennials. Just the other thing before I leave you, Christian, is there's at least they're quite vocal millennials around ESG and environmental considerations. If you're targeting that market, is that something that you've thought much about?
Oh, absolutely. So at Fortlake, we actually are publishing in academic journals and effectively taking it to a different level altogether. Because when we looked at the ESG market, we've said, look, the problem with the ESG response is that it's effectively been consumer-led. And for some bizarre reason is it hasn't been led by the academic community, i.e. there was no sustainable finance topics at most of the universities until a year ago.
Yeah, yep.
And it's really quite bizarre that it's really started from investors and consumers. And so what we've said is, with our university affiliations, let's get out there and use our practical knowledge of the fixed income market and see if we can actually start to put research out there and start to effectively backsolve and provide academic literature and empirical studies which help people to effectively make sustainable finance decisions. So we are publishing in some of the best known academic journals. In fact, in the next week or two, we're going to be publishing in one of the top journals, and we've got one of our employees actually talking at a conference in Spain, obviously via Zoom. But yeah, so we're effectively going that way. And, you know, the important thing about ESG is to incorporate it into your decision-making process. So it's about understanding what it means for the credit fundamentals of the issuer. So if you've got poor governance issues like what you've seen at AMP or something like that, ultimately that has a long-term detrimental effect on the credit quality of the issuer. So it's about pricing those risks, understanding them, and then putting a rating on those risks and making sure that you understand how it will ultimately affect the pricing of those bonds.
Christian, thank you. I always think about bond markets. They should be simpler than equities, but they're not. They're just incredibly complex markets. And even the ESG overlay, for example, and governance and those issues, it all kind of feeds into the pricing of bond markets. And you almost need to be an expert to really understand it, I think.
Absolutely. No, it's an incredibly complicated market. I always say when you look at equities, you've got one security. There's no different parts of the capital structure like what we've got to deal with.
Yeah.
You've got one name. And it's very simple, one instrument. When you look at fixed income markets, issuers have typically 10 or 15 different bonds that they go and issue. They issue them in multiple currencies. They're at different parts of the capital structure. And then you move into the interest rate world where you've got different rates, different names in all parts of the world. You've got Euribor in Europe, which is basically like our bank bill swap rate here. You've got the Fed funds rate in the US and all of these different microstructure elements. So it is an incredibly complex asset class when you actually go beneath the surface.
Well, hopefully Blossom allows people to access that market, particularly people who normally wouldn't. But again, I say we're not a financial advice show. I'm certainly not registered as a financial advisor, so go and speak to a planner. Christian, thank you for talking to Fear and Greed.
Thanks very much, Sean. Nice to chat.
That was Dr Christian Baylis, Founder and Chief Investment Officer of Fortlake Asset Management. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.